Look, most traders know they absolutely should be journaling, but they avoid it like the plague, right? Mostly because they think it takes way too much time. They're picturing themselves typing up some massive, long essay after every single trade. But honestly, a good trading journal shouldn't feel like high school homework. It should just help you capture the most crucial details quickly so you can actually use that data to make better decisions. The whole goal here is speed plus consistency. So today, we're going to break down exactly how you can start journaling your trades without wasting hours of your life. Let's get right into it. But first, I've got to ask you a pretty tough question right out of the gate. Do you consistently follow your risk? Think about it honestly for a second. Do you have a strict, hard financial number that you risk on every single trade, and do you stick to it literally no matter what the market throws at you?
The consistency trap. Why traders fail. If your answer to that question was no, well, you're probably caught in what we call the consistency trap. And this is a painful reality for a lot of folks. You make a little money, you get a bit overconfident, maybe you increase your position size randomly just because you've got a gut feeling, and bam, you blow the account because of unmanaged risk. It's a vicious cycle.
It's exactly like trader Umar Ashraf so bluntly puts it. Our main job every single day is to manage risk. It's not just obsessing over the potential reward. Most traders enter a position only thinking about how much cash they're going to make. You absolutely have to flip that mindset and go in 100% focused on how much you are risking.
Master your R multiple, the core math of trading. Before we even think about software or cool shortcuts, we have to anchor ourselves in the core mathematical truth of trading. This is literally the foundation of your edge.
So, what is an R multiple? Basically, it defines exactly what you risked divided by what you ultimately made or lost. This calculation is a total game changer because it forces your focus entirely onto risk management. It strips away the raw dollar amounts, which, let's be real, can totally mess with your psychology, and tells you exactly how well you're managing capital relative to your risk.
Let's look at the math here. Say you risk $300 to make $600. That's a positive 2R. You made twice your risk. Awesome. Now, a loss of $300, that just means you followed your stop loss perfectly for a negative 1R. No big deal. But risking $300 and losing $600, man, that means you completely failed to follow your stop, you let the trade run against you, and you took a terrible negative 2R. Anything worse than a negative 1R means your discipline is cracking.
Stop manual data entry, eliminating friction. Now, the main reason you probably aren't tracking this math already boils down to one simple word: friction. It's time to completely stop manual data entry. Because honestly, if you have to type every single trade into a blank document manually, you might do it for a day or two, but eventually, you're going to skip it. Just compare the absolute misery of manual spreadsheets against auto-broker imports. With spreadsheets, you skip days, you create massive data gaps, and eventually you're just staring blankly at your screen. But modern platforms? They flawlessly sync your trades instantly from over 500 different brokers. The second you close a position, it's accurately logged. The whole shebang. No typing required.
To put that into perspective, eliminating manual entries saves you roughly 8 to 10 hours a month on an active account. Think about that. That is incredibly valuable time you get back to actually review your trades, study the charts, and refine your edge instead of playing data entry clerk.
Finding your trading edge, visualizing data. Okay, so once that data is imported automatically, you need a quick way to filter out the noise and find your true edge. You don't need 50 confusing metrics. You just need clear, actionable data that tells you if your process is actually working.
A super clean analytics dashboard takes that raw data and does all the heavy lifting for you. You can quickly see your win rate and your profit factor without drowning in a sea of numbers. It shows your average winners versus your average losers right at a glance. That is how you turn raw imported trades into a crystal clear picture of your performance.
And hey, keep this in mind when you're looking at these numbers. Sample size matters massively. For example, a breakout setup showing a 2.8 profit factor across 42 trades, that's a real proven edge. But that exact same 2.8 profit factor on just 9 trades, that is purely statistical noise. Never change your whole strategy based on a tiny sample size.
The prop firm advantage: tracking multiple accounts. Now, when trading becomes your actual full-time job, casual spreadsheets completely fall apart. You need infrastructure that holds up across multiple brokers and prop firm accounts all at the same time. This is where tools like TradeZella's Prop Firm Sync give you a massive upper hand. It centralizes everything. It tracks your evaluations, monitors those super strict daily drawdown limits, tracks trailing drawdown headroom, and even logs payout schedules across unlimited accounts, all in one clear view. No more guessing what your real numbers are on a Monday morning.
Building your trading habit, speed plus consistency. So, with all this incredible tech available, how do we actually build this into a daily routine that doesn't feel like a chore? Setting up your journal should take less than 15 minutes, and maintaining it should take just a few minutes a day.
You honestly just need to follow these 5 fast steps. First, keep it simple. Second, use tags instead of writing long, boring notes. Third, automate your imports entirely. Fourth, review your trades in batches at the end of the week. And finally, focus on fixing just one single mistake at a time. Seriously, don't try to overhaul everything at once. Looking at a calendar layout like this shows you exactly why batch reviewing is the way to go. When you have clean, consistent data auto-populating across your calendar, you can just sit down for a quick 20-minute Sunday review, click on the days you traded, and quickly spot what worked and what didn't. Zero stress.
And a massive part of making those reviews lightning fast is step 2, using tags. By simply tagging your emotions and setups, like marking a trade as a breakout or tagging it as FOMO or late entry, you reveal your behavioral patterns instantly. I mean, seeing a chart that shows 15% of your mistakes are due to FOMO, that is way more actionable than reading through paragraphs of random thoughts.
Now, if you want to eliminate even more manual work, TradeZella actually has Zella AI built right in. And this isn't just some basic chatbot. It completely automates the tagging of your trades based on your specific rules, and it even generates comprehensive session reviews for you. It literally does the heavy lifting, giving you gapless, consistent data.
So if you're ready to streamline this whole process, stop wasting your precious time, and start truly protecting your capital, hit the link in the description below today. You can grab 20% off TradeZella's monthly or yearly plans by using the promo code WAR20.
As you start building up this new journaling habit, I want you to drop a comment down below answering this final question for me. Are you going to continue the frustrating cycle of trading on gut feelings, or will you let clean data finally uncover your true edge? The choice is entirely up to you. Get out there, get tracking, and I'll catch you in the next one.